one of the biggest obstacles when it comes to China investing in the past is that the market has never correlated with the economic growth of the country. And there has always been a phenomenon that global investors can't seem to grasp or understand. Yeah. In my opinion, the reason for that is very simple. It's the indices are just completely off. I mean, if you look into its composition, unlike the S&P 500 today, which only focus on a few handful of companies being the dominant weight, all China indices is geared towards a few sectors. So you have, for example, the internet subsector represents like 40% of the index. Then you also have financials that represent 20% of the index, and that's already 60%. And not to mention that 20% of the financial sector companies are basically all SOEs. So the remaining 40% of the index, half of that are also SOEs. So you're only really just left with 20% of the index that supposedly represent the rest of the China economy. Yeah. It's not a good representation. And I think that's probably the real reason why the market, so to speak, has never reflected the China's growth. Now, the one thing all you need to do to kind of put that into perspective is if you just strip out the index from SOEs and private sector. I don't even need to do any stock picking. Just break out the private sector from the index. If you annualize return of that over the past, let's say 15, 20 years, actually outperform S&P 500.
Wow.
Yeah. So I think that is really where a lot of the opportunities in China come from. And I think that's the biggest misunderstanding.
So what you're saying is Western allocators or institutions are still looking too much at a headline number.
Yeah. Correct.
That is in no way represent. More importantly, they're leaving money on the table because if you actually look at the true constituents of the real economy, they're outperforming.
Absolutely.